Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. This is Monday morning, January 23rd. The market is open. It's been open for about, 45 minutes. It's in the green. The volatility index is down below 20. This is an important week for the market because the Fed is actually in a blackout period. So we can't hear what they have to say. Many of my colleagues, especially from the Wall Street side of things, think this is great. Stay away, too much talking. However, I do want to point out that it was last week's comments, I think, that really helped put this market in a better mood, if you will, particularly from Christopher Waller. He is seen as someone who is pragmatic, perhaps on the hawkish side. And when I say hawkish, by the way, it means that these are people who are not going to just cave and say, let's keep rates, cut rates, let's just have financial conditions be easier and easier. No, he's much more pragmatic than that. And because of that, when he said, I could see 25 basis points at the next meeting, inflation is coming down, he said all those things that the market is seeing, and that perhaps many of the more hawkish side of the equation on the Fed is saying, we still have to keep rates high, we have to keep going. He was much more, in the view that, if inflation keeps coming down at this point, we got to acknowledge that. Similarly, one of the presidents of the Fed Bank, who's an outgoing Federal Reserve official, she is pretty hawkish, but she even said, inflation is coming down, maybe even a little bit faster than we thought. And then we had the head of the Philadelphia Federal Reserve Bank coming out, and he's highly regarded. We haven't heard from him that much in the past, but for last 6 months, he's coming out speaking, and he also has come out and said, look, we are seeing inflation come down. I would suggest that 25 basis points is appropriate. Very important, because to repeat, as we came into the beginning of this year, right, when the Federal Reserve speakers were coming out, they came out, oh my goodness, really, really hawkish. We're going to stay on hold all year. We're inflation is sticky. We've got to keep at it. Very important, I would have to say, shift. That said, now this is important. We key to see that wages are coming down in the labor market. It's important, and I repeat the reason. It's because when wages are higher and keep moving higher, what happens is prices go up as as companies and small business owners try to pass along those higher costs to the end buyer, meaning us, the consumer, or fellow businessmen. And if we continue to pay that, it just pushes inflation higher. And what the Fed is looking for is an equilibrium in the marketplace between supply and demand amongst workers and what employers want. We're beginning to see that, but it takes time. And what we need to see is a continuation. In the next report that we get, the payroll report, we need to see that wages continue to move down. Something else that we're seeing in the employment landscape, which is important, and that is to say that the number of hours worked coming down just a bit. And that's telling you something important. It's telling you that the economy is slowing just a bit, right? We'll keep our eye on that in the next payroll report. Also, this is an industry report, and that is that temp hiring is down. Very important. I think everyone knows that temp hiring tends to be an important signal when we're coming out of a deep recession, right? And unemployment rate is way up. We look to see if temp hiring increases. It's a precursor. It tells us that workers are needed as the economy picks up, but employers don't want, to have a deep relationship with these employees, because you never know. There's always a question. Well, where we are right now is a question as to whether or not we even go into a recession. We still don't know. We know that the economy is slowing, but I have to report in this call that the numbers for the fourth quarter, GDP numbers, are still in positive territory, and even though last week we saw that retail sales were down, the consumer still has money in the system. By that I mean in the banks, because the banks report how much money they're seeing in consumer accounts. The consumer still has cash, and by the way, the consumer still has a job because the unemployment rate is now at 3.5%, pretty good. But the retail sales numbers were important last week because we also saw a downward revision for the month of November. December, we saw retail spending down a bit. And this got the market pretty nervous as to, hey, wait a minute, does this mean we're headed into a recession? Still on the cusp of, we don't know. Is it going to be an earnings recession? That's a little bit different. Or are we going to see the unemployment rate to skyrocket and the consumer, where we're responsible, by the way, for about 70% of GDP. So all of this is still an unknown. But to repeat, what is helping the market right now is that some of these Federal Reserve members are saying, you know what, let's pay close attention to the data and let's understand that things are changing and the backdrop is changing, and that is to say inflation coming down. Along those lines, I also want to mention on this call, that all of the industry reports suggest that we are going to start, not right away because it's lagging, but we're going to start to see that rents are coming down. It's going to start showing up even at the margin, meaning just a little bit. But once that starts to come in to the idea that rents, which is something the Fed has been watching very closely, they have seen that high rents are sticky, meaning it's hard to break it, but they are starting to come down. Every industry report suggests that. And at some point, either in the next Consumer Price Index report or the one after, we are going to start to see that evidence that is beginning to ease. It's starting to come down, and that'll be very good news for the Fed to ascertain that we are seeing what they thought was so sticky beginning to ease, beginning to break a bit, and that's important. But again, remember the CPI report, the PCE report that we're getting on Friday, all of it looks back, right? It's not current. The other aspect to the market, and just looking at last week, was the PPI report, Producer Price Index report. It came in much cooler. It came in, prices are coming down. The prices that are paid out coming down. In addition, we are seeing in the manufacturing reports that we just had, the Philadelphia Fed, the Empire Fed, which is New York, New Jersey, and Connecticut, basically, we're seeing that things are slowing, and slowing, I have to say, quite dramatically. And the prices paid coming down, hiring expectations coming down, and that those headline numbers that we're seeing overall coming down, meaning contraction. So these are the data releases, right? So there's no really arguing unless you don't believe any of them. And we look at trends. So the trends are showing that it is contracting on the manufacturing side. Manufacturing is about 10% of our economy. Everything really is in our economy: service sector, consumer, consumer spending, and so on. So there, in terms of the Institute for Supply Management, the ISM purchasing managers, manufacturing has been coming down. And now we're also seeing in those headline numbers, again, that the consumer part of it, ISM service sector, is also just beginning to pull back. Not dramatically, but pull back. Now, in terms of earnings, because we are in the earnings season, right? Remember, we're looking back into the fourth quarter. What we're seeing so far, and by the way, so far what we have seen is that about 67% of the S&P 500 companies have already reported their earnings. They're beating the expectations on the top line. That's revenue growth. That's the money that comes in. They're beating it by about 64%. And also the bottom line, meaning earnings per share, they are, how will I say, coming down a little bit from the last measuring period, same time last year. So we still have a lot of earnings to go. But what the market wants to see, and this is important, is more positive guidance, surprises to the upside. That's what will, have this market understand, yes, companies are not doing as well as they did in the same period a year ago, and the expectations are, by the way, that it will come down, right? It will be weaker. But if they can see positive surprises and a sprinkling of positive guidance, it'll be important for the market, moving out of a period of where we're really watching to see what is happening and what about layoffs. This is crucial. We're seeing the layoffs come from the tech sector, and we're seeing layoffs come from financial services. But we really haven't seen a broad scale layoffs of, workers in the bigger companies, the companies that everyone knows about, and particularly those employees who are, in the front office. We call them white collar employees because they earn, enough money to keep spending, but they're not in the high income bracket that maybe the folks say in the financial services are, or even in tech. So the market is going through this process listening to what these companies have to say, watching the headlines about layoffs, and we have to understand that the unemployment rate came down from 3.7% to 3.5%. Still resiliency in the economy, but there's no doubt about it, the economy is slowing. The question now is by how much? That's where we are. Now, in terms of the earnings last week, the Netflix numbers came out. Actually, the market thought this is good, this is okay. And the other part of this story is look at how the market reacted to layoffs in Google, Alphabet. The market wants to see these tech companies right size. It wants to see the tech companies come in and say, look, we understand advertising is down. That's Alphabet depends on a lot of advertising, and we're going to right size. And that's what we're seeing across the board in the tech sector. This is important because then their costs come down. And again, what the market wants to see is, what about valuations? Are they going to start to come down too? Helping the big tech names that are, exporters of their products and services is the dollar coming down as well. Remember, every time a significant Federal Reserve speaker makes a comment, as we heard last week, about, maybe the Fed even pauses, right? We heard that last week. That pushes the U.S. dollar down against other currencies because it's a much more dovish statement. It's not as aggressive as some of the speakers we've heard in the past. So again, this is important because a weaker dollar does help U.S. companies exporting the goods and services overseas. So a lot riding on where the dollar comes in. And also, I want to point out in terms of this week's data, most of all, this week's data is focused on the end of the week. This is when the Fed's preferred measure of inflation comes in. This is the Personal Consumption Expenditures Index, known as the PCE. And we want to have confirmation from this report that comes out that inflation is coming down. And if it comes in cooler, when I say cooler and you hear that, it means it's coming down faster as opposed to hotter. So again, we're looking at all the things we look at. We're looking at rents. We're looking at the cost for travel, healthcare costs, and so on. That's going to be important because the market again, is completely focused on what is the Fed going to tell us on February 1st. We believe absolutely it'll be 25 basis points, but is the rhetoric going to be hawkish? Is Powell going to come out as Mr. Hawk? Is he going to come out as Mr. Dove, or something in between? We've seen that in Powell's press conference appearances, where he can meander between being a hawk and being a dove. And the market says, okay, what are you going to be? I should also point out that even today, as I was doing this call, leading indicators down more than expected, down 1%. This is for looking back on the month of December. But again, the data are coming in weaker than consensus estimates. This week, we are also going to have durable goods. We pay attention. We know that the consumer is not spending as much money on durable goods, refrigerators, anything that lasts a while. But this is what we're looking for, by the way. Core durable goods. That is actually what companies are spending. Capital expenditures, CapEx, you've heard that term. This is what companies are spending. And it's been steadily positive, slowing just a bit. We're going to see what companies are doing. And if they continue to spend, by the way, the market likes that, because it tells you that companies are not terrified of an impending recession any moment and holding back on spending. So we'll report that next week. Also, we'll get a new picture of real income and the University of Michigan's inflation reports coming in on consumer sentiment, but also, very important at the end of the week, what the one-year outlook is and what the five-year outlook is on the U.S. consumers' view of inflation. The Fed watches this. They don't want to see all of us saying suddenly, gee, we think inflation is going to keep rising, and the Fed sees that as an important indicator of where expectations are in the future. In terms of earnings this week, can't stress this enough. Boy, this is across the board. Everything from 3M to Tesla, MasterCard, Visa, American Express. I mentioned those, MasterCard, Visa, and American Express, because what we want to hear is, how are we spending? They know everything. And we want to know who's spending, how they're spending, and here's this, are we have late payments? Are we paying on time? Have they cut? And this is crucial. Have they gone in and told folks who have the credit cards, by the way, we're cutting how much you can spend? We see this at the beginning of recessions or during recessions, where they come in and cut spending dramatically, the amount that you have. We'll see if they've done this, and we'll basically hear what they have to say. And I like it because American Express covers business spending quite a bit, but also a higher wage earner. We'll hear about that cohort and how American Express sees the spending patterns for folks that earn a bit more. So again, Visa, American Express, and also MasterCard. I'm looking at that because I have all of them, all three of them, somewhere between my husband and me. And, we're right there in some of these cohorts, right? When I say cohorts, I mean groups. Also, we're going to hear from some of the defense names, Raytheon, Lockheed Martin. This is important because the defense names, by the way, Goldman Sachs, for example, had a report and downgraded them and said, look, we're worried about maybe in the lead up to the fight over the budget, that the budget, American U.S. budget, cuts defense spending, and that would have put pressure on it. Yet we're seeing Morgan Stanley on the other side saying, nope, we see defense spending picking up and holding. It's going to be interesting when we hear from both of these leading companies within that space in the defense space. Also, we're going to hear from Chevron. Important because, everyone is looking at oil prices. Are they going up? Are they going down? When we look at those big integrated names, however, there's more to it than that. We know that their spending on huge projects has slowed. They're not going into drilling and production as much as they used to when they would come in with cash flow that was growing. We want to hear how much are they giving back to the consumer, or investor rather, in terms of dividends and share buybacks, and what did they see in that broader landscape in terms of the larger energy complex. We know that the refiners are doing well, and we also know that the services are doing well. Those are the big companies like Halliburton, just to give you an example, they talk about their role in the energy complex of servicing the companies. So now we'll hear from the integrated names, those are these big energy companies, and hear what they have to say about the future. Remember, right now, the International Energy Agency came out with a report suggesting that oil usage is going to go up, and that even China, which will be responsible for about half of the increase in daily usage of oil, that they've even started, even with the fact that they're hardly reopened because of COVID, but that they're seeing imports moving up just a bit. Remember, China is the world's largest importer of oil, and the market has been expecting that they are going to start picking up dramatically once they open completely. They have to get through the Lunar New Year, where folks are traveling and actually bringing COVID out into the regions in the countryside, and the market is watching this. Maybe this gives them herd immunity at some point, but the market is expecting that as we get into the second quarter and third quarter, that COVID within China will be, under control, and that the consumption factor, just like we had in the West, where folks say, we want to go out, we want to enjoy, being out and feeling, we could go out and have a cup of coffee somewhere, we could go out to dinner, they want to travel. The pattern is expected to be very similar to what we saw in the West and what we saw in the United States. That said, China remains an important component of the global supply chain in terms of manufacturing, and so that's the expectation, is that we're going to see oil usage pick up. So all of these are unknowns, they're all parts of a puzzle, and this is why we always say the market gets the news first and the market looks ahead, and this is where we are focused on, and that's why the earnings season is so crucial in terms of the guidance, because the guidance is going to tell us what companies are hearing from their customers and their clients. And that's the looking ahead part that the market must do, particularly at junctures that, like this, is where are we headed? Are we in a recession? Are we going into one? Or is it just going to be a slow, deep slowdown and maybe just a really shallow recession? This is what the market is focused on and what we're focused on. And we'll be back next week. Don't hesitate to call. I can't thank you enough, and appreciate being in touch with me when you have questions. Thank you again. This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.